Currency exchange is the demand and supply of money. Currency markets are markets where you have the exchange of different currencies on a foreign exchange market. So you have national currencies that are exchanged, and the rate at which these currencies are exchanged is called the exchange rate. So exchange rates function to allow consumers in one country to put foreign goods in terms of domestic prices, because currencies don't have parity or equality in value around the world, and a lot of that is based on the size of the economy, economic growth in different nations. So, for example, if the dollar to yen rate, and yen is the currency used in Japan, if the dollar to yen exchange rate is 1 penny per yen, then a TV that costs 20,000 yen in Japan would cost $200 in the United States. It allows us to have a conceptual value of the cost in terms of our own currency, so we understand the value a little bit better. So how you get that price is you take the price in yen times the exchange rate, and that gives you the cost in US dollars. So foreign exchange rates have varied slightly over time. Before we got off the gold standard, and the gold standard simply meant that the United States Treasury or Mint didn't print any money unless they had gold bullion in a vault somewhere to back the dollar or the paper currency they were printing. We go off of this in the 1970s at the Bretton Woods Conference, and so we have foreign exchange rates and flexible exchange or floating exchange rates that start after we leave the gold standard, and so that's based on the demand and supply of currency, or demand and supply for each currency. So currencies fluctuate. They appreciate or they depreciate. Appreciation, when you have a strong dollar, means it takes fewer dollars to buy more currency, and it makes goods cheaper in other parts of the world. But it makes our exports, or stuff leaving the United States to go internationally with products that we sell internationally, more expensive. So when we have a strong dollar, that means that our economy is strong, but it also means that we're less likely to export stuff because it makes it more expensive for other people in other countries to buy our products. Depreciation is when we have a weak dollar. It means it takes more dollars to buy less stuff or buy more of another currency. And that results in very expensive imports, so trading from other countries or bringing goods from other countries to the United States becomes very expensive for us, but it means our exports are less expensive, and so we are more likely to export more things when we have a weak dollar. The dollar market is the graph that we use to look at the demand and supply of dollars in the foreign exchange market. So you have the supply of dollars, the demand for dollars, the quantity of dollars on your x-axis, and your y-axis is the dollar price in terms of yen, because our other currency, or our second graph in this particular illustration, is the yen. So anytime you shift the supply of dollars or the demand for dollars, and the new equilibrium price is above the first equilibrium price, that's what we call appreciation. Anytime you have a new curve drawn that the new equilibrium price is below the first equilibrium price, that's depreciation. So if you were to draw a supply curve and the new intersection of the demand and the new supply curve would be here, your currency would have appreciated. If you were going to draw a new supply curve and the new intersection of the demand curve and the new supply curve would be here, that would be depreciation. Your other currency market, in this illustration again, it is the yen, looks exactly the same. You have the quantity of yen and the dollar price in terms of yen over here for your y-axis, and your x-axis is also your quantity. So the yen can appreciate if appreciation would be a new supply curve here, depreciation would be a new supply curve here. So what causes changes in the currency market? The currency market changes because of change in income, which makes sense. If national income increases for people in the United States, we're more likely to purchase goods internationally, or just purchase goods in period, or just purchase goods, period. Taste will increase or decrease the demand for other currencies, our preferences, our fads, and the relative price level. Inflation in one nation makes foreign goods cheaper. When we have a high rate of inflation in the United States, we're more likely to seek goods outside of the United States because they are more affordable. Real interest rates will also influence the demand and supply of money because investors want to earn money on financial assets abroad if interest rates are higher. So if the interest rate in the United States is 6%, but let's say in Australia it's 10%, investors are going to want to invest in Australian assets rather than U.S. assets because they could make more money. So if you need a review of the currency market, go back to your 16 graphs or your paper that will eventually have 16 graphs on it and review the rules for currency market graphing.